Okay, so first we'll learn about all the different kinds of equity mutual funds available. There are quite a lot, right? So why we're learning this? Because you know exactly which equity mutual funds to avoid, right? So let's get started. First is the large cap fund. What is a large cap fund? As the explanation says, these funds invest 80% of the money in the large cap companies of India. What are the large cap companies of India? The top 100 companies by size. So all the companies are ranked by size because everybody likes size. So every day what happens is every second actually when the stock market is running, all the companies are ranked. There are around 6,000 public companies in India. All the companies are ranked as per the size of that company, right? And in that list, the top 100 largest companies fall into the large cap category companies of India, right? So this particular fund, large cap fund, 80% of the money is investing in the large cap companies of India. Now, should you invest in this? No. I'll tell you why. You shouldn't invest because 82% of large cap funds are unable to beat the index over the past 5 years. Now, I'll tell you first what the index is and I'll tell you why this has been happening. Index is nothing but you heard of Nifty and Sensex, right? So this is what the index is. And it is an indication of how well the Indian companies have performed, right? For example, let us take the example of Nifty. Nifty is the top 50 companies of India, right? Top 50 companies of India compared to the top 50 companies of India in 1996. So what are we trying to do? We are trying to see since 1996. Why 1996? Because that is when they started measuring it. Since 1996, how has the top 50 companies of India grown, right? So in 1996, they would have allocated Nifty's number as 100. Today, Nifty is around 16,000. So 16,000 divided by 100 is what? 160. Meaning the top 50 companies of India has grown by 160 times since 1996. That is what index means. Similarly, Sensex, I think Sensex, the reference point is around 1978. They look at the top 30 companies. So Sensex is around what? 40 to 44,000 today. So since 1978, the top 30 companies of India has grown by around 440 times. So that is what the index means. Now, all mutual funds of India are trying to beat this index, right? Because they want to show that they are worthy of asking you money, right? So mutual funds are asking you money through expense ratio, right? Expense ratio, let's say 1%. If you have invested 100 rupees with a mutual fund, they're taking 1 rupee as a fee for helping you manage your money. Why? Now to justify that taking that money, right? They are telling you that they are able to beat the index by so much percentage. They are so much better than the index, right? So every mutual fund company's objective in India is to beat that index. Now, if a large cap fund whose objective is to beat the index, right? And if it's not able to beat the index over the past 5 years, then why the hell are we investing there, giving so much money extra to them? They charge 1% of our money. Whereas index fund, which is the next category over here, index funds charge around 0.1%, 0.2%. So why not invest in an index fund? Because the large cap fund is anyway not able to beat the index. Why the hell am I paying 5 times, 10 times more money to a large cap fund, mutual fund company for not even being able to beat the index, right? So the first lesson is do not invest in large cap funds in India, right? Because 82% of large cap funds are unable to beat the index. Now, why is this happening? I'll tell you now. So every economy, when it is developing, it is very easy for the companies to beat the index. As it becomes developed, for example, let's say United States. In the United States, index funds are very popular. Everybody is investing in index funds. Actively managed funds struggle to beat the index funds. What is actively managed? Actively managed is when there is a fund manager sitting and actively looking at your money to see which companies to invest in. Index fund, it is all algorithm. It's all automatic, right? So, in developed countries, it is very difficult. As the country becomes more and more developed, it becomes more and more difficult for actively managed funds to beat the index. Now in India today, large cap funds have already crossed that era where they are able to beat the index. So now avoid large cap funds. Mid cap funds and small cap funds are still able to beat their respective index because they are smaller companies and India is a fast growing economy. So there is still ample scope for medium sized and small sized company to beat their index. Right? So that is why it's still a good idea to invest in mid cap and small cap actively managed funds in India. But large cap funds have already crossed that era of being able to beat the index. So avoid it. In fact, see, because it's a very small number of companies, right? Large cap funds, only 100 top companies of India. And there are around 400 equity analysts for every company, analyzing these companies, right? There are 400 research papers which are coming for each of these companies on their analysis. So when there is so much abundance of data available for these 100 companies, when there's information overload, everybody gets that advantage of understanding which company is good. So there is not much scope for beating the index. Whereas in the mid cap and the small cap category, there are hundreds and thousands of companies. So it is not possible for everybody to analyze every company. So there is still ample scope for these mutual fund companies to beat the index when in the mid cap and the small cap category. I hope this is clear. If you still have doubts, please post your query on the Freedom Community app and we will help you answer your doubts, right? So next category is index funds. Index funds, like I said, are directly copying the index. I already told you what is index, the Nifty and the Sensex. So these funds, the mutual fund manager is not required only. They just write an algorithm, blindly copy the top 50 companies of India. That's it. In the same allocation as per their size. Right? So whatever the top 50 companies are of India, these funds will blindly copy investing in these top 50 companies. That is what an index fund is. Because it is blindly copying, there is no manual labor required. So that is why the expense ratio is very low. It's around 0.1%, 0.2%. So index funds, definitely you should invest. Right? And it is the cheapest and the safest way of investing in the stock market. So definitely invest in index funds. We will cover how to invest in index funds in one of the next chapters. Don't worry. Next is mid-cap funds. Mid-cap funds invest 65% in mid-cap companies. What are mid-cap companies? These are the companies ranked from 101 to 250. Yes, you should invest in these companies because, like I said, there is still ample scope for mid-cap funds to beat their respective index. Small cap funds, same story. 65% of the money is in small cap companies. Any company, okay, there is a mistake in this deck. It is any company which is beyond the 250th rank, right? So I will correct that. So beyond the 250th rank, all the way till the end, right? There are 6,000 public companies. From the 250th rank to the end, all these companies are small cap companies of India. As you can see, since it's such a large group of companies and every mutual fund is investing in not more than 20 to 30 companies. So out of 6,000 companies, they have to pick 20 to 30 companies. So that is why, as you can see, there is ample scope for the mutual fund manager to beat the index. Okay. Now, coming to the comparative performance between large cap, mid cap and small cap, you might be thinking that, small cap funds have giving better returns. Right, because these are smaller companies. Because they're smaller companies, they have more room for growth compared to a larger company. And so some people might incorrectly assume that why not put all my money in a small cap fund because I am investing for long term. I'll tell you why that is not good. Look at the past performance over a 5-year and a 10-year period. What you can see over here is that over a 5-year period, mid cap fund has been better than a small cap fund, and even a large cap fund has been better than a small cap fund, right? And when it comes to a 10-year period, the mid cap fund is still better than the small cap fund. I mean, small cap fund has beaten large cap, but mid cap fund is still better than small cap. So if the moral of the story is, during every period of time, there is like one apna time aayega movement for each of these categories. So during the bear phase, small cap funds get absolutely trashed, because smaller companies during difficult times struggle, right? Whereas larger companies have huge amounts of money to deal with the recession, right? So that time large cap funds are performing good. Whereas during moments of bull run like last year, small cap companies overperform significantly compared to the large cap companies, right? So that is why do not put all your eggs in one particular category of mutual fund. You need to allocate across multiple categories of mutual funds. Now, what should the allocation be across? For large cap, it is index fund. Don't invest in large cap funds. So, what should be the allocation across index, mid cap, and small cap? That has been discussed in the module 2. Remember, when I discussed the financial planner tool, there was a table in the domestic equity sheet which talks about, as per your age, what should be the allocation across large cap companies, mid cap companies, and small cap companies. We will revisit that tool again in this module itself. To revise that particular thing again. Don't worry. All right. Next is flexi cap funds. These funds invest at 65% in large cap, mid cap, and small cap, and they can keep varying. Right? There is no restrictions. Meaning, at one point of time, if the mutual fund manager feels small cap is performing well, they might make all 65% small cap. That's why it's called flexi. There is no rule between what should be the large cap, mid cap, and small cap allocation. They can increase small cap from 0 to 100%. Even large cap could be 0 to 100%. And mid cap, 65%. Even mid cap can be 0 to 65%. Now, my recommendation is you can invest here, but I'm saying it is not mandatory. I personally don't invest in these funds because it is a little more riskier, because it depends on the fund manager's expertise to know whether small cap is indeed going to be the best performing category. So as to put all of the 65% allocation into small cap funds, right? So I think that requires a little higher expertise, and the bets might not always be correct on the mutual fund manager's end. Also, flexi cap funds are a new category which was introduced 2 years back. So it is we still need to observe whether these funds are able to beat the index, right? So I would say hold off from investing in these funds. But can you invest? Yes, you can. It is not wrong to invest in these funds. Is it mandatory? No. But these three funds, index funds, mid cap and small cap funds, mandatory. You have to invest in these. Coming to multi cap funds, invest 75% in large cap, mid cap and small cap. And there is a rule that 25%, minimum 20, maximum 25% in each of these categories. Meaning the mutual fund manager cannot just increase small cap category to 50%. That is not allowed here. So should you invest in multi-cap funds? I would say yes, but not mandatory. I personally do invest in multi-cap funds. Next is dividend yield funds. These invest only in those companies that give high dividends. What are dividends? Dividends is nothing but a company, as you know, they make profits. Now, profits are usually reinvested into the company on new projects. But when a company becomes too big, I also covered this in one of my Instagram reels. When a company becomes too big, for example, let's say Coca-Cola or ITC, they have exhausted all their market potential. Now what do they do with their profits? They're not able to grow faster. But if they're not able to grow faster, the stock price is not increasing. So, but then the investor will be unhappy, right? So they redistribute these dividends to profits to the investors in the form of dividends. That is what dividend yield funds are. I would say don't invest in these kind of funds. These are usually for those people who want a regular source of income from these funds, right? But when you are in your 20s, 30s and 40s, I'm saying you should not invest in these funds, because you should not depend on mutual funds as an income for you during that time, because you're still earning money that time. So I would say this is recommended for those people who are retired. Next is value funds. Now these funds invest in companies based on fundamental characteristics that are undervalued in quality, right? I would say don't invest in these funds. You're better off with index and mid cap funds. You don't need to invest in value funds. Next is contra funds. As the name suggests, they invest in those companies which have a contrarian opinion in the market. Meaning the market thinks that these companies are dead and not going to perform well, but the fund manager has discovered something about this company that it's going to change its fortune. Obviously, that's a little risky, so I would say don't invest in these funds. Next is focused funds. These funds, as the name suggests, invest in a small focused group of companies, maybe not more than 7 or 8 companies. Again, it's risky because it is very, very concentrated portfolio. So I would say avoid investing in these funds. Next, thematic funds. Again, these funds invest only in a particular industry, right? It could be like investing only in pharmaceutical companies, investing only in IT sector companies, investing only in infrastructure companies. Again, I would say too risky, because these funds are invested by those people who are taking a bet in the market that this year infrastructure is going to perform well. This year, medicine is going to perform well. Pharmaceutical is going to perform well. And they invest for a short period of time, like 7 or 8 months, and then pull out their money, right? Because they have some insider knowledge about this industry, thinking that this industry is going to perform well. Obviously, there's a lot of risk involved in this, so I would say avoid these funds. Next, ELSs. Now, ELSs funds invest 80% in equity. The major purpose of investing in these funds is for tax saving purposes. Whatever money that you invest in these funds, you don't have to pay tax for them. Meaning, if I make 1 lakh rupees, let's say I made 10 lakh rupees this year, out of that, if I invest 1 lakh in ELSs funds, for that 1 lakh rupees, no tax. That is why these funds are very popular. Having said that, they have a 3-year lock-in period. I would say yes, you should invest in these to save taxes. I personally invest in these funds.